Towards the end of 2025 and now getting into 2026, what I've noticed is a movement in the trend of what I call the traffic light analogy in real estate. And if you've been following me for a while, either on this YouTube channel or through my Instagram, you're probably pretty familiar with what this traffic light analogy is. But for those of you who are not aware of what that is, I'm definitely going to explain it right now in just a sec. But when we start seeing movement, that is when we can predict that the next cycle has essentially started. Remember, this does not predict the pace, the speed of how much momentum we will build across multiple properties or going down the property chain over the next real estate cycle. But it has indicated that something has started in the grassroots level of the real estate, that generally larger headlines and just looking at overall data, market sentiment will really not cover. So without further ado, let's get right into a graphic that I think clearly explains what this traffic light analogy is. And then I'm going to pull out very specific data and graphs that I have generated on my backend spreadsheets to illustrate how this works and what we can expect happening next in the 2026 Calgary real estate market. So right here, we can see the three different phases or steps that illustrates what the traffic light analogy in real estate is. So generally, when an entire cycle has closed out, like we saw at the end of last year, where apartments and townhomes became way too expensive and then the entire market had to start correcting, what's happening now is all the property types, starting at high-end luxury, mid-range, and of course you have more segments within each of these property types, but this is just to illustrate the overall proposition, because the first thing to move is the high-end luxury. So you can see all of these property types are essentially going to be waiting behind what we call the traffic light. And the data we monitor is when activity starts peaking up for high-end luxury. In high-end luxury, that's where you first start seeing people pay above list price, shorter days on markets, a little bit more competition, and all for the good properties, and especially properties that are priced well. So now, for example, while they're all waiting behind that traffic light, what we watch for is when do high end start crossing the traffic light. And the data that I'm going to illustrate today will showcase this exact phenomenon playing out right now. Definitely ignore this additional traffic light that's not meant to be here. But as you can see, once the high end starts going, what can we expect to happen next? And that is what the phase three, which hasn't happened yet, will happen. And that's how the entire real estate cycle plays out, is the high end all of a sudden now starts becoming a little too expensive. The value proposition to stick with high end is really not there when the next property right below that is relatively cheaper and equal value proposition. And then you start getting buyers move down the property ranges. So as you can see here, we go from high-end luxury. The buyers then use what we call the substitution effect. So the substitution effect is when there's an equal or very close value proposition available in the market, but at a better price range. And then the buyers start cycling through that. And then when that starts crossing the traffic light and becomes a little too expensive, you start seeing bidding wars. Then people move on to the next. Now, what can also drive all of this is additional factors. So it's not always just the price, but the price is the final effect. That can also then be driven by what we've seen in the last 2-3 years, for example, shortage of supply. So if we do not have enough detached homes or duplex homes in the market, if there is just not enough inventory, then people move on to the next and what looks to be the next best deal. And buyers cycle through till duplexes start becoming expensive. Now, duplexes is a very small segment of the market, so it doesn't really last very long in terms of buyers staying there for a long period of time. It's just a lot of demand with very little supply at all times. And then it moves on to townhomes, becomes a bit too expensive, apartments. So apartments now have become way too expensive and need to see that correction. And so buyers then cycle back all the way back to high-end luxury, because now high-end luxury, and it's not the same people. That is the thing to keep in mind. It's not necessarily this buyer that always could only afford apartments is necessarily the one now moving to high-end luxury. It is just where does the focus of the market shift. So right now, for example, if we are focused more on these, and these are where people will and that's what I expect for 2026, is people are going to be focusing a bit more on high-end luxury and detached properties, potentially duplexes in really great areas. That's why duplex is also expected to maintain a very healthy market going through 2026. So it's just, where does the focus of the market shift? And this illustrates what the traffic light analogy is. Why is this important? Because we want to understand when the substitution effect happens. Say, for example, you are not a buyer in the high-end luxury, but you are in the market for this and you're not experiencing any pressures right now, you're not seeing multiple offers, you don't feel like you need to come off the sidelines. But being aware that you'd be next in line and watching the data for when this starts picking up is very, very important. And like I said, there's way more fractured segments between these two. This just illustrates the high level idea of how this plays out. But within high-end luxury, we would monitor million plus. Then we would have possibly around 800,000 to a million. So that's just above what we call the affordable index. But then it's still not really luxury, but it's buyers that have a little bit more money. That moves first. Then after that, sub 800,000. Then all of a sudden, the properties that are sub 600,000 see extreme demand because everything else has become too expensive. And then we cycle through. In different cycles, this can take different amounts of time. This plays out over years to get the demand all the way down, but it is something definitely to watch, and that's what we're going to go through in this week's video. Starting out with a graph that I track again on the back-end spreadsheets is to just track what the sales per day for any given property type is. And the reason for doing that, of course, sales within a given week doesn't really matter a whole lot, but what it shows long term when you track it is how much momentum is building up. And what I mean by that is, how quickly do you go up over, say, a couple weeks or a month? How long do you stay there? And what are the highs that you're setting in terms of max number of sales per day? What's the lowest points that you're setting? And when you compare this year over year, it really shows you a lot. So for example, if you go back to 2024, you can see we started around starting of April right here with a peak amount of sales. And then we died by the end of May, which is essentially what you call the spring market. The highs that we set are around the 80 mark. Now, did we touch that in the next year? Yeah, so that is a good sign. We have that same level of optimism. However, it did not last as long. We had it barely just through May, and that was really the peak. So now, for example, when I meet my sellers, for example, anyone that had a failed listing last year with another realtor, and then they reach out to me, they mentioned that they got inspired by the peak pricing in May, and then they priced their property accordingly but came in a little bit late. This graph shows you exactly what you would have expected, because you were pricing for this market right here for a very short window of optimism that showed up. But then if you came even, say, half a week, 2 weeks later, you're actually in a very, very different momentum, because now your lowers are setting lower lows and then your peaks are not as high. So I think it's important to track something like this and just understand how much momentum is building up. Looking into 2026, of course, we're building a good momentum going up, and it is more or less in line with previous years. Of course, you can see 2024 way more consistent. We have a couple peaks here and then significant drops, but overall our trajectory is going upwards. And what we have to wait and watch is, do we continue this momentum and go still up? And then at the end of the day, do we hit the same peaks? So knowing when to list your property, when to get the maximum exposure and capitalize on the market, that's where I feel this is extremely helpful. So overall, detached is moving up in terms of demand. Now let's take a look at what this means in terms of specific price ranges within detached. So taking a look here, and this illustrates what I meant before. So in blue essentially is sub 500. So here you can see all the price ranges for the different bars that are on this graph. And this goes all the way back to start of 2024 through 2025 and 26, because this is something doesn't really matter month over month. You really want to see what's happening across the entire year versus the previous year. So this is a year over year graph that generally has that level of impact. Really, there's only one key observation. As you can see, orange is the most expensive, and that is $2 million plus properties in detached. What's happening to those? So as you can see, this is detached median sold price versus what they were originally listed for by the amount of price ranges, right? So If the graph is longer, essentially they've sold that much lower than their list price. And this is a median. So it averages across the entire month. Of course, now it'll be dramatically affected by if there was a really expensive property and then the relative price range drop is not as much, which is why you don't want to look at any specific month. But what you can see across all of 2024, for example, versus all of 2025 is that the orange peaks overall are just longer. So there are far more price drops happening in the amount of sold price for $2 million plus in 2024 versus 2025. While there are price drops compared to those list prices, they are relatively short. It actually averages out around here versus here. If you would average it out, it'd be somewhere around here. So what this shows is momentum's building up in that high-end luxury. So if you are looking at high-end luxury properties right now and wondering why the properties either don't stay, they relatively would still stay on market, but the time they stay on market is coming down, and you do not have as much bargaining power, for example, you had in 2024 because everyone was distracted with the lower end of the market. And as we follow the price segments to the different detached types, you can see here, as far as the greens go, overall, the greens had a shorter length in 2024. So it averages out around here versus the greens in 2025 are actually longer overall. And the same thing follows through for the yellows. So the yellows are 750K to 1.25 million. So you can see here they're overall shorter. That's pretty much the max length that they reach across all of 2024, even a positive for a month there. But as you can see across all of 2025, not only are they negative, but they're actually getting longer and longer. So what that means is the market sentiment has shifted back now to the top of the cycle, and the high-end properties have moved past that green light. And what's going to happen next is once these orange ones start getting a little too expensive and the substitution effect happens, you're going to see the green ones start getting a bit shorter compared to 2024. So then 2025. So the next thing we will track is 2026 against 2000. So once we have more and more data for 2026, you will know once the next segment has moved. So the next segment that would start seeing demand, we can predict, of course, we don't have a glass ball to see when it's going to happen, but it's just, we know for sure it is going to happen at some point. And that's going to be the 1.25 million to 2 million. After that peaks out, then you're going to have the next demand cycle at 750 to 1.25 million, and then that will carry down and carry down to the affordable range. So hopefully this illustrates very clearly using data how the market cycles are actually going to work, where we are right now, and what's coming next for detached properties. What effect does this have as far as price drops, as far as being able to leverage and pay above below list price, or even as a seller, where do you position yourself on the market? So taking a look at a bit of longer term data for 1.25 million plus. So going back all the way to July, you can see here in terms of the amount of price drops, of course, heading towards winter market, the price drops increase significantly around here. October, November, that's when you have peak negotiation power, peak desperate sellers, and that's when you have the max number of price drops. So that's just seasonal. But overall, there's still a trend before that heading down a little bit. And of course, now coming out of winter market, that's heading back up. How does that reflect on property selling above and below list price? So as you can see, back in July, that's the range that we were looking at. But of course, in winter market, significantly lower. And then now it's heading back up. What's interesting to see is we are starting to set higher peaks than where we were right around here. So if a property prices themselves correctly, competitively, and demand returns to those multi-million dollar properties, you're going to see higher pricing properties and more competition on the really good properties on the market. As far as days on market peaked again right around here, right around October, but now since then has been declining back down. So you can expect better markets going forward. But again, your listing is extremely important. It's proper to find good pricing comparables and make sure you're not lagging behind in the market and trying to then catch up. When you come on the market, it's very extremely important what price range you come in at. As far as detached sold price, You can see here $2 million plus. So the detached prices have actually been going up since July over time overall, and have now kind of leveled out and are now heading more towards a sideways trend. If you just zoom in a little bit into just looking at only from October, of course you have lesser data to look at, but this gives you an idea of that price drops that I spoke about before, and then property selling below this price, exactly around how much. So this is 400,000 below. But now you can see dramatic shift compared to where we were in the mint market. So if this is the price range that you're in at, whether as a buyer or seller, you know now what's going to happen going forward. Days on market, not as what we had in the winter time. So 150 days on market, and then it managed to sell, versus now going forward, you're looking at about 100 days, but a lot of them are significantly lower than that, so about 30, 45 days. So that shows that to have in such a short period of time a dramatic drop like this in the average graph really shows how much momentum is building up on that luxury market. And when we compare this to the lower price properties, it's going to be very obvious why that market is definitely very different, and this doesn't apply to everything else. So quickly taking a look at, say, 600,000 to that $1.2 million mark, you can see here in terms of price drops, it did drop more, I would say, around the October, November, so still seasonal data, but nowhere as close to the number of drops and the extent of drops that we saw for the luxury market. As far as property selling above and below this price, they've already started seeing the momentum come out from here. So this is from October onwards. And as far as detached, the number of days on market, of course, it peaked around here, but that's also started now coming back down. So we're seeing demand on that side. How's that resulted in terms of the sold price? It's mostly sideways. If you really look at it, it has dropped a tad bit, but of course this is the affordable section, but also really good properties. So as that demand carries forward, we can expect this price range to start coming back up, but not just yet, because everybody is still on that high end of the market. And so you can see, while you can feel the effects of the market overall coming out of winter market, but as far as the price range and everything else, it still doesn't yet reflect the high end part of the market. And sub 600K, the affordable range, still drop in price overall, but right about here you can see mostly sideways movement for selling above and below this price. Slight tick up here, we have to see if that continues. And in terms of price drops, of course, the most desperate sellers around here, so now that started coming out. If you actually zoom out on this one a little bit, and I'm curious to see what all the way from July looks like, the price drops of course peaked here, but it's nowhere as dramatic as what we're seeing on the high end range, and selling above below this price, just a sideways movement. So we have not seen enough inertia on the upper side, and it's mostly just sideways. So there's still not enough negotiation power, or there's more negotiation power on this lower range, because we haven't seen return to demand yet on this side to the levels that we are seeing on the high end market. And as you can see clearly on the sold price, it's still reflective. The sold price is still dropping, and a bit of sideways movement. Detached still remains a very attractive sector overall, which is why you're not seeing a dramatic correction here like we would see on townhomes and apartments. But it is extremely important to understand how that demand is now going to cycle through from high end through the different segments. And we will, of course, on this channel keep a close eye on this, so that if you are either looking to sell or buy within a certain segment, you would be able to know when is roughly the right time for you to come on market, and what your expectations should be if you absolutely have to either buy or sell this year. Now, quickly taking a look at just the number of listings that we are seeing coming out of Jan and into Feb, and compare that to sales. So as you can see, the number of listings clearly has shot up way faster than the sales, but the sales is trended upwards. So we can expect some level of leveling out. Now, whether these listings are listed correctly or priced correctly, that is really what's going to determine where all this demand funnels into. So not every single property is going to do well if you don't price it properly correctly. If you don't present it well, then you're essentially going to cut out those buyers, and those buyers will go to properties that are priced better. However, if you do a good job right now, this is where your demand's picking up. And I do expect going into spring market, we're going to see this level back out and come a bit higher and settle at a higher point. Probably not as high as last year, but I do expect a demand level somewhere here. Now, of course, since this is a reset of the cycle, you could potentially see demands here because a lot of people looking at this graph have sat on the sidelines and waited it out, except for maybe the fall market. But now looking at better prices and properties that they actually like, you might be able to get a lot of that demand back. And that's where really this market's going to sell really well this year. And then probably towards the end of spring or maybe going into fall, sometimes within the year, you see that switch happen if that gets expensive too fast. But now, since this is not expected to be a year where demand is going to be at the levels of what we saw the last 3 years, I don't expect that carry down effect to be, or substitution effect to happen as quickly as before. I hope you found this video extremely helpful to understand this key aspect of the real estate cycle, how we look at different specific segments, their data, and what's going to come next. And while this is not really a crystal ball to time the market, and I always say never try to time the market, and it's an extremely dangerous game to play, but it is important to understand the overall, I would say, timeline or life cycle of an entire, say, 10-year segment of a life cycle for a real estate. Because when you're looking to buy or sell, you should never be timing it for 2 or 3 years. However, you do want to buy and hold for at least 5, 7, ideally even 10 years. And over a 10-year cycle, generally, a real estate always balances out or comes off on the top. So that is very, very important to understand. Now, if you're in the luxury segment, you've had a hard time selling, or you are trying to find what the good properties are right now to buy, definitely reach out and I would love to help you. Because guess what? The areas that were selling on the luxury segment, say a year or 2 years ago, is very, very different from what we saw to the end of 2025. So it's not just demand shifting on the price range, but demand's also shifting in terms of the communities that are preferred by people, and it has changed certain trends. So that is very important to understand when pricing your property, because if you price your property based on what was preferred before, you'll just be sitting on the market versus actually being able to approach the buyers that are interested within your community. So, like I always say, data, stats tells a lot, but it's very important to dissect it correctly and understand what the overall market is trying to tell you. If you're in the market this year for buying or selling in any of the other segments and curious how all this data is going to carry forward and help you, because there are certain segments you absolutely do want to avoid this year. So if you want that level of advice and knowing which communities you should not buy into, make sure you reach out. I'm also going to put links in the description to my community guide, my buyer guide, put the QR codes up here on the screen so you can get those straight to your inbox, have a physical copy, and know with confidence how to approach the market in 2026 going forward. And like always, I would absolutely love to have those conversations with you. If you're interested in real estate, there's a call you can book in the description. Absolutely no obligation. I love talking about data and real estate. If you're an investor, buyer, seller, move up, move down buyers, anybody. And I would love to get on that call with you and build a custom solution to what your specific needs are. Because irrespective of what the data tells you, you really need to understand what your short, long-term objectives are and design a plan for that. And that's it for this week's video. And very soon, of course, we're going to have the market update come out for the end of Feb, understand what's happened in Feb overall by the Calgary Real Estate Board. So stay tuned for that. And if data like this is something right up your alley and you want to make the right decisions in real estate going forward, make sure to subscribe so that I can reach more people like you, but also help you out going forward. And you stay tuned when more videos come out. Till next time, take care.